But once again, investors were disappointed by a hotter than expected report on inflation. And again, it makes no sense to me that so many people expect inflation to be coming down when nothing the Federal Reserve has done thus far is equal to the task. In fact, it's not just that what the Fed has done is inadequate to reduce inflation, but the U.S. government itself has done nothing to reduce inflation. In fact, everything they've done is throw gasoline on the inflation fire, because ever since inflation became an obvious problem that people were complaining about, the only response we've had from Washington is an increase in government spending, which just compounds the inflation problem. The Federal Reserve has to move interest rates above the inflation rate. So long as the Federal Reserve artificially suppresses interest rates by holding them below the rate of inflation, something that would never happen in a free market, but as long as this is Fed policy, it is stoking inflation's fires, not putting out the inflation. And again, it's not going to make any headway unless it has cooperation from the government. You can't have fiscal stimulus and fight inflation. You need contractionary fiscal policy married with contractionary monetary policy, which is why the Fed is not actually fighting inflation. Of course, it can't admit that, so it has to pretend that it's fighting inflation while it secretly continues to create more. The prior month, well, not only did the November number come out above estimates at 0.3, but then they went back and revised the October up 0.2 to up 0.3 as well. So in the way, the forecast was correct in that both November and October producer prices increased by the same amount, but it was wrong in that both months increased by 50% more than everybody expected, but not as much as estimates. It came down to 7.4%, and that was actually above the consensus range, which went from 7.1 to 7.3. And if you take out food and energy, it was even a bigger miss. They were expecting an increase of 0.2. The real increase was 0.4, again, above the range of estimates, which went from 0.1 to 0.3. And adding insult to injury, they took the unchanged number that was reported in the previous month, and they revised that up to an increase of 0.1. But the bottom line on this inflation report card is that even though it may not be an F because it was a little bit lower than the prior month, it's still a D minus, and that's not a passing grade. Even though it's still below the year-over-year numbers from the prior month, you're still looking at 7.4% year-over-year increase in producer prices. And even if you strip out food and energy, you're still looking at 6.2%. That's more than triple the 2% target that any of the so-called progress that has been made is permanent. There is no proof that this is anything other than a temporary decline in an ongoing upward trend, meaning that the high year-over-year rates of inflation that we put in may well be eclipsed in the next run-up. Everything ebbs and flows, and that's all that's happening with inflation. There's going to be some relief. Every bull market has a correction, and we have a bull market in inflation. Inflation is going to keep going higher. Is it as bad as the high water mark, which I think was about 11%? No, it wasn't as horrific as that, but it's still a bad number, and we're still on a bad trajectory. And I think sometime in 2023, we're going to set a new high water mark for producer prices, particularly when the current recession ratchets up to a new gear. And that's likely going to be when we get the big increase in unemployment. That even though the Fed's not making any real headway on its goal of 2% inflation, as soon as it gets some help from unemployment, once unemployment spikes up, well, that'll do the Fed's job, and that's going to bring inflation back down. No, the big spike in unemployment is going to kick inflation into a higher gear. And the reason that's going to happen is that the minute the Fed has to acknowledge the weakness in the labor market and starts adjusting its monetary policy by moving it to an easier trajectory, the Fed has completely denied even existed, the dollar is going to tank. And when that happens, you're going to see a huge surge in commodity prices. And all of this is going to exert more upward pressure on both producer and consumer prices. The main reason that we haven't seen a bigger increase in those prices is because of the strong dollar in relation to other currencies. But the dollar has only been strong because the Fed was committed to doing whatever it takes to fight inflation, that battle. Well, then the dollar is going to be collateral damage, and all the so-called progress is going to be reversed because a weak dollar is going to put upward pressure on prices, not just prices, but on budget deficits, trade deficits, and on long-term interest rates. Remember, as the recession deepens, revenues decline going to the government, spending increases, we have larger budget deficits and more pressure on the Fed to create even more inflation. We continue to get more evidence of the underlying weakness in the jobs market. We got the weekly unemployment claims on Thursday, and the increase was slightly better than estimates of 230,000. But the more significant number was the continuing claims, which are now at 1.7 million. This is the highest number of Americans filing continued unemployment claims since February 5th. Also, if you look at the way the markets reacted to the hotter than expected inflation news, particularly in the precious metals markets, it indicates that investors are finally slowly waking up to the reality that when we get these bad inflation numbers, it's not a sign that the Fed is just going to have to fight harder to win its inflation war. It's a sign that the Fed is losing that war and that it's incapable of fighting hard enough to actually win with that reality. Because when the number came out, gold did exactly what it's been doing. It sold off. All of its gains were erased. Gold was up better than $10, I think around $12, $13 before the number, and it went into negative territory, but just briefly, and it quickly recovered, and it closed up almost $8.50 on the day, just under $1,798 an ounce. Silver did even better. Inflation numbers, whether it was PPI or CPI, which we're going to get next week, gold and silver were getting crushed on the news that inflation was higher than estimates because of the fear of a more aggressive Fed fight. That would mean rates would be higher for longer, which would be a headwind for gold. Well, now the markets are shrugging that off. You still get the knee-jerk, reflexive kind of reaction as the algorithms immediately sell into that news, but cooler heads are prevailing, and people who are actually thinking are taking advantage of these computer cell programs to buy the dip in gold and silver because they understand that higher than expected inflation is not bad news for gold and silver. It is good news for gold and silver.